Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Wednesday, May 1st, 2021. So we now have the much anticipated, or maybe not so much this one, I should say, FOMC meeting. Still always has the potential to move the markets, and as expected, they didn't hike rates. There was a near certainty, based on the federal funds futures, the Fed CME Fed rate tool, that they weren't going to cut rates, and there was a little bit of a relief rally that he didn't mention raising rates, and but again, it's status quo. So that to me is a complete non-event. Markets do what they do. If I've said it once here, I've said it 10,000 times. The initial reaction on following an FOMC announcement is quite often not the lasting reaction or the one that sticks. So I'll get into the charts in a second and just kind of give an overview. What we're going to do is keep this video limited to the update on the equity markets and the related Treasury bond TLT or ZB trade, since that's indirect hedge as well as a pure play. So I wanted to start here with the VIX and just say, it's going to be a common theme that all the sell signals, somebody asked a question, was one of the replies I made earlier this morning to a comment about, what to do, where to reshort, et cetera, et cetera. I think they had covered their shorts yesterday. I said, of course, everyone has their own trading plan, their views where the market's going, but most importantly, in summary, nothing has changed. I've had a litany of sell signals. Every one I was looking for, I laid them out far in advance, and that includes, but not limited to, a breakdown of 433 on QQQ, a breakdown of all the top five or top four. We even got all top five sectors of the S&P 500. Treasury bonds getting into my yellow and then orange zones. Crude oil getting into the yellow, orange, and then even kissing the red zone. Again, that's the inflation trade. So check marks across the board. Trend indicators flipping over. I'll go over that in a second when I get to the markets. On the weekly charts, the PPO histogram. So, and I'm just starting out here with the VIX because I tend to forget it sometimes. A perfect back test of the uptrend line. So the VIX is still in an uptrend right now, making higher highs and higher lows. Still very much intact. We had that little post-FOMC whipsaw, and now this is today's FOMC meeting. This was a much more muted reaction this time around. There were really no surprises and not much of a reaction from the market. So that keeps the market on a sell signal with the VIX in an uptrend. And now let's go to QQQ. Well, time permitting, I'll get to SPY and IWM, but Q is the big one. I'm just going to go, let me start here. Just in case there's anybody new to the site that's coming in this week, and I'll just kind of recap those sell signals I talked about. So we had this trading range here in QQQ with a big level around 433. That was this multi-month trading range that we entered way back in the beginning of February. Broke down there. That was on the heels following the top sectors in the S&P already breaking down as well. Some of the formerly known as Mag 7 stocks, we still have a few that haven't yet buckled, and those will kind of be like the nail in the coffin thing if and when those go. I'll get to those in 1 second. So we broke down there. That was on, what is that date? April 15th. Tax day there, and that followed the most recent swing short entry here. That was the last Fed meeting. The Fed pop took us to the highs, so we shorted the highs, added there. Again, these are all objective short entries or add-ons. Active traders could have gamed, bounced down to the bottom of the range, gamed many of these bounces, and we did. We gamed, shorted there. The back test, we had 2 days of back testing. 433 couldn't get through, went down to hit T1. Where I stated my preference to not try to game a bounce. I think we'd go down to T2, where I did state a preference to game a bounce because a bounce was likely. We came all the way back up, 433, perfect back test of the bottom of the trading range, and here we are. So in a quick summary, and not to oversimplify it, but bulls win if this happens, bears win if this happens. For now, right now, really, and I've said this even before we broke down 433. My plan was and remains to not add. I don't think it's objective to keep adding shorts. Right now we are on sell signals. So you do want to, it is objective to short rallies back into resistance, like the recent one there, and one I'm going to give you today on the short-term charts. But my preference is not to add. I'm not going to immediately, if we pop 433, there's a myriad of other factors I'm going to look at, Treasury bonds and where the key stocks are and sectors and everything else. But I'd be more concerned about scaling out, and I will begin to start scaling out somewhere above 433 if we get it. Right now, we have just nothing but a textbook, 100% textbook breakdown, hit of the first solid support where I expected a reaction would be likely, back test, and a rejection. Okay, so again, to reiterate, it doesn't get any better than that. That doesn't guarantee we're going to T3 or T4 or even T5, but I still maintain that with a sweet spot here around T4, punching down briefly through the 200-day moving averages. Again, that's for a long time here, been calling the markets down to those 200 days. And nothing I've seen today or recently has dampened my expectation for that. In fact, if anything, the fact that we rallied back up and got rejected off 433 helps to solidify that case, and that the odds will go up. I'm just like a sports bookie. I don't bet sports. I don't care for it. This is my form of betting, if you call it. But if the odds on a game, if you're, they're going to change as time goes on. When you're getting up to a football game, basketball game, whatever it is, depends on injuries and this and that. Even weather conditions, if the Dolphins are playing the Bills and it's going to be a blizzard up there, well, that, gives the Bills an upper hand advantage. So what I'm getting at is the odds are in real time, and they will go up if and when T2 is taken out. It's going to sharply increase, and at that point, and I've also been highlighting how I think this whole thing will play out, and that's when we'll probably start to waterfall down through there. I predicted we'd kind of have a pretty nice waterfall selling when 433 was taken out, which we did. You can see that was a big drop in just 2 days. We got down there, 2.5 days after that back test right there. And so I think if and when we take out the recent the hit T2 about 413 and change, that should be a quick swoon down to the 200-day moving averages. Likewise, if we get up there, who knows, maybe we'll see short covering and we could move up pretty quick to the top. So the important thing is that we recognize, the charts are dynamic. They change day to day and then react accordingly. So there's that kind of the rough trading plan, or actually a pretty precise trading plan for this current swing trade. And then you drill down to the shorter term charts. This is what the 60-minute looks like. It's a busy board here, meaning I have a lot of lines on here, but that's the same trading range right there. The breakdown followed by a little consolidation, bear flagging action, the move down there, the run up here recently. And so today you can see we stopped right at 433.10 was a support line I've had on here, and that was capped the rally today. And some of my go-to favorite time frames to trade are the 15-minute charts for active trading. This is QQQ here. You can see we had a resistance zone here. It defined the top of this recent trading range. That was when we were backtesting 433. A clean, distinct reaction high right there. Another distinct reaction here. And the bottom of the trading range once we first broke down below 433. So that was resistance, a logical place to add shorts post-Fed. So far rejected, and the way it works is if we take out that recent low, probably move down, take out that one, and then most importantly is take out this, that was where T2 was hit. You can sharpen your pencil even further and go down to the 5-minute charts. This is the realm of the active trader, I always say. And the same basic tenets or things that cause major trend changes on the long-term charts, the weekly and the daily charts, they work just as well in the 60-minute and all the way down here to the 5-minute charts. These little divergent highs, you can see them all marked. Divergent high, divergent low, divergent high. And a lot of these I've already shared in the past. We're active trading in the range. Then we broke down from the range, and I said more apt to, morph back into swing trading mode. But lately, after hitting T2, remember, we were quite oversold. It was an 8+% drop off the recent highs. And so the markets got oversold. Coming off, all-time or even 52-week highs, animal spirits are always going to be high. And we know they've been high recently based on sentiment surveys. and price action. So what I said on T2, the reason we gained the bounce is it was almost guaranteed. It was about 100% probability you're going to get a wave of dip buyers coming in on a first really good support level, especially when you had confirmation like positive divergence that a trend change was likely. And so there was the bounce. And then, nothing goes straight up. Divergent high, correction off that divergent low, first rally. Divergent high right back into 433. On the 5-minute chart in the 15s and the 60s, I had it at 433.70 was the actual, come down to the 5-minute charts, you can get a little more precise on the support and resistance levels. And then this is just post-Fed right here. This is today. We came into the day, little small divergent low right here on the 5-minute chart, rallied right up, right into downtrend line resistance, and so far rejected. And that should be it for the, like I said, that's, it's the weirdest thing in the world, guys. I don't know how it works, but like I can't recall, and maybe there has been a time after an FOMC announcement where the initial reaction actually stuck and you just built on it. Whether the initial reaction was an immediate sell-off, and they're usually within this just range, couple percentage points, just like the one we had last Fed meeting, which rallied up, took us to the top of the range, and then boom, nothing but 8% drop after that. And so here it is today. You buy this. I had CNBC on just to listen to the press conference with Powell, and you hear these talking heads as it's bullish. Yeah, the market went vertical, and it's bullish because he didn't talk about rate hikes. There was nothing bullish today. If anything, they backed off the bond purchase, the runoff for their balance sheet a little bit, and that was slightly more dovish. But here we are, guys. Again, if you look at where we were just 6 months ago, expecting late last year 6 rate cuts, and now there's virtually 0% chance. We didn't get one today. Very little chance at the next meeting. Powell made that pretty clear. The inflation's kind of been stubborn. And remember, for Powell to be not outright dovish, I use the analogy, the scorpion and the frog. He is the scorpion. It's in his nature. He's a raging dove, and it's killing him to not even be more dovish. So when he's not very dovish, like today, when he's just saying, well, we're going to have to keep rates where we're at now and wait for the data, blah, 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 that's hawkish for Powell. And so, look, bottom line is his hands are tied. It's not his fault or the Fed's fault. It is that we're here to a large extent, to 100%, I'm sorry, easy money policy, not COVID. Forget about COVID. Since 2008 financial crisis, keeping the pedal to the metal, thinking you could keep rates near zero for well over a decade, that's and so finally, inflation, the cat's out of the bag. So here we are, guys. That's it. We're back flat. QQQ. Let me show you NQ for the NQ traders. I'll try to get to the others. 60-minute chart, same one I've been sharing. You have multiple copies of this on the site. If you just go to the bottom of this video, click on NQ or QQQ, it'll bring you to previous post with these charts, both in videos and screenshots. And so there it is. We fell shy. 18,046 was the bottom of the trading range on NQ. Fell a little shy of that right there. And today we rallied right back. And this is the level I've had here. I've had a resistance zone, 2 levels close together. Very well defined. Lots of reactions over the last few months, including this period of consolidation, reaction high there. And that's where we rallied into today. So it was a very objective and logical area for this rally to stop, and that's where it did. Okay, so again, where do we need to go? I'm going to pull a line. I'll add a line to this chart. I often do that during the videos. Let's see right here. We've got a little spike, a little reaction low there, and more importantly, this previous reaction low. I think that was earlier today, 17,400. So if that goes, it should open the door for a move down. And let's go to our 15-minute chart here. This is also favorite go-to swing trading time frame here. You've got this is today. We had the heading into the meeting. You had the first 15-minute divergence, positive divergence since back here. That was just PPO divergence, but it gave us this beautiful little wedge and a back test of this trend line. This, and that was gave us that thrust up. So you can see they're not all marked, but this was a divergent high right here. You gave us that, divergent low gave us that. And you remember last week I had this on this 15-minute chart. I shared it with you, 17,993. That was my initially all-in entry, and then I started, active trading again, in, out. Got back in, but that to me was and still is a big level. Why is that a big level? I just showed it to you on QQQ, but you can see it here as well. Consolidation range, breakdown, failed backtest. If you see the breakdown, we kicked back, backtested, rallied all the way back up off that low, failed there again, pulled back, failed again, broke out, had a trading range. Bulls celebrated that, but that trading range failed right at the top of the other one and at 433, broke down again. So it's a big, big level. And again, I just want to point that out. And these charts were given out in advance. So that's the state of the NASDAQ. Let's look quickly at small caps. No big change there. If you're new to the site, in summary, you really have to go almost back to the weekly chart. IWM peaked back in 2021 right here. We had this beautiful, very tight and long sideways trading range with a false breakout and a divergent high. As I often say, breakouts that occur with negative divergence and overbought conditions have a much higher, in fact, a very high failure rate. And not only do they fail, they tend to just go the other way because it's quite bearish when that happens. When you have a breakout to new highs, blows out weak-handed shorts, sucks in the last of the bulls, on the sideline, buyers that were chasing the rally, and then it just has a shift in the supply-demand dynamics. And so that was it. We went down, hit the bottom of the range once, one last bounce, broke down, and tried to backtest it for months there, about a month or two, a couple months maybe even. Failed, then broke down from that trading range, and that was it. So just recently we had, what I view as a gift, another rally all the way back to that level, and it's really the top of this much larger trading range that was, set up under there. So the small caps remain well off their 2021 highs, and in fact, we just hit the top of the range. It says we'll probably go down to the bottom range and ultimately my T4. And that's it on a weekly chart. Daily chart, it looks like this. You've got the I know this is a little bit busy. Just look at the blue lines as I draw them. We had that beautiful uptrend line, nice and clean. I say beautiful. The more reactions, the more valid a trend line. Our divergent high, negative divergence, breakdown, back test, TA 101, failure. Recently broke down the 199.70 key support level. That's why I had it colored yellow. It's important support. Support once broken then becomes resistance, rejected. Again today, if you look closely, rejected. So that's what happened today. Post-Fed, dip buyers stepped in, whatever, or the algos, I don't know. It's high frequency trading. I don't know who gleaned anything bullish out of what Powell said today, other than he, like I said, that's what CNBC was trying to spin it as. The fact that he didn't talk about rate cuts was how they took it away as a dovish meeting. Okay, go figure. They'll always retrofit or a headline onto an excuse for a rally or a drop. That is one thing I've promised you over the years. Once in a blue moon, they'll come out and put their hands up in there and say, we don't know why the market went up big today, but 99 times out of 100, they'll cite a reason, even if it makes no sense and it's not the right reason. A lot of times these are technically induced moves in the market, and rarely, if ever, do I hear them say, "Oh, well, QQQ had a big, 8%, big drop because it broke below 433, which was very good support earlier in the year." They don't do that. We do that. That's what we do here. Technical analysis, guys. What else? What else for you? Let's see. Oh yeah, TLT. Let's talk about that. Threw that out recently as both either a pure play or a direct hedge, and it was actually pretty good timing on that one. When we had ZB, let me see. First threw it out in ZB. That chart, screenshot it and got it out to you at 112.280, which was the exact low. I think if not mistaken, to the penny, it was right there. Nothing big so far, but I wanted to put here, we have a couple recent reaction highs here. That's where we rallied to today. And it still looks good. I'm still, told you I took this one personally as an indirect hedge. And to do that, you need at least a double, at least a 2-time position. You can do a little more. I typically will do about that if I'm full hedging up. And what I mean by that indirect hedge is, of course, it has, I'm not going to say it has nothing to do with QQQ, but it's a different asset class, it's bonds. And so if you look at what happened today, let's just say you had that short. So this is to yesterday's close right here, right? I'm on a 1 minute chart. So QQQ was down earlier, and then post-Fed, there's the pop. So I'm going to snap here. I'm going to measure up. If you look at the pop-up box to the left, QQQ got as high as 1.32% today. TLT, which is the ETF version of what I just showed you, TLT, got as high as 1.07. TLT, remember, you'd be two-time positions. So you were actually up at that point 2%. Again, over 2.14, more than offsetting any give back that you had. So that's why I like these indirect hedges. I'm going to sit tight with it right now because I still think the chart's constructive. I'm not married to this. I think rates are going higher this year. I just think we could see a flight to safety bid here, or for whatever reason, the charts say I might remove that. I'll let you know if I do remove that hedge, but I still think there's potential to maybe come all the way up here to this downtrend line before we get the next leg down in Treasury bonds, which means, remember, that's rates falling, bond prices going up, because you go long, you buy the bond, not the rate. So we'll go up. That would be a maximum target. Again, I may not hold it all the way there, and then see a thing down. What could cause that? Well, a lot of things, but one of them could be a quick swoon down in the market. And that would potentially drive some money into treasuries as a flight to safety bid. And so I've said this before, but again, I know there's always new folks coming in. I do these indirect hedges because if I can get it right, if I'm right on the outlook for TLT, I wouldn't use it as an indirect hedge if I didn't think it had a chance to rally. And I wouldn't still be short QQQ if I didn't think it was going lower. So if I get it right, guess what happens? QQQ falls, I profit on that. NQ and the small caps, my RTY, and then Treasury bonds can go up. But on a day like today, it washed out that post-Fed give back. I showed you I could have gamed it. I saw that 15-minute. I didn't. I just sat still. I didn't feel like trading today, so I wrote out the pop up, and it was nice because my treasury bonds were offsetting, and then some the give back that I had on my NQ shorts coming into today. So and then going forward, like I said, if I'm lucky, this happens. Treasury's up, and the market goes down, stocks go down, and if not, like I said, I'll manage this like every other position. Okay, that was all closing bell. Markets are now closed. I'm just going to wrap this up by going over the stocks formerly known as Magnificent 7. We had that recent trading range. It was a breakout of this bigger trading range right here in Microsoft. Microsoft reported there was one little whipsaw. My big level, again, remember, this goes back for months now. Wanted to see Microsoft take out 397. Even better when this goes. These are also my initial targets I've covered down here. The 200 days and 364.54. That's where I think Microsoft's going before the first decent tradable bounce, where I'll probably cover in reverse and swing long a bounce. But again, I say that, and then we hit T2 and I bounce. I'll tell you today, tomorrow. I can tell you right now, I really don't have at this point in time any intentions of gaming anything for a bounce until I see things like this, about 376.35, and that's the 200-day moving average. That's the first place the buyers will probably step in, if I'm right, where Microsoft's going. But then I watch this, I watch QQQ, where's that at the time, SPY, IWM, Treasury bonds. It all goes in together and then kind of gets churned up in a little machine in my head and then spit out, and that gives me where I want to either start covering shorts and or going long, meaning reversing. I just wanted to point out that we had the breakdown of 397, but closed right about on it. And I said it was right before earnings. They popped above earnings, but as I mentioned yesterday, they faded 100% of earnings and then some. The earnings popped 100% and then some. And yesterday went back below 397. Look what happened today. Tried to get back above there today. No dice. Rejected on a daily close. So we are now second close post earnings. So now all the noise, if you will, is out of the way. And so that's a check mark for me right there on Microsoft. Apple is what Apple is. Like I said, it's got some divergences. One of the better looking charts, but also flirting with major support, and also long since gave me a check mark. Remember, this is no longer anything magnificent. Apple peaked all the way back in July. I mean, we're talking last summer. We're already in May right now, and this thing peaked in July. Put pretty much a double top there, and it's at the bottom of that range. So again, Apple, and all the better if it solidly takes out the recent lows, which are just below that 166-ish purple level. Nvidia, very big one as well. Had a trading range, like so many things, especially tech related stuff. Took it out there, back test. Took it out one day, but also I said had a trend line. I wasn't overly concerned because you had a downtrend line, and you parked on 1, 2, 3, 4 days on there, back below it. And today, not by a lot, but we're back below 840. So that was just a little pop through there. Remember, this is the crowd favorite. Apple used to be the crowd favorite, and then it was Tesla for a while, and now this is the crowd favorite, meaning the stock everybody wants to own. And so the dip buyers did what they do. The battle bears can't declare victory, like I said, because we're cut now up and above 840, but we did get rejected on the downtrend line off the highs. And at this point, again, I want to see my next. Remember, my yellow line still hasn't been taken out. 840 was a big one for me. It was an additional sell signal. But the yellow line I've had forever and a day is at 742, and that intersects with this purple primary uptrend line. I know we're going back. I know it's a busy chart. Bear with me. Get the uptrend line off the October 2022 lows, coming in with 742, and that would give us a more powerful sell signal. Can't promise you where we're going from there. Well, I can tell you where I think we're going, but I can promise you it will drag the market down with it. You kill the general, the 5-star general, you're probably going to win the battle here, the war. And I'm talking about the war between bulls and bears. So the target is down here, about 500 to the bottom of that trading range. You got the 200s to come in first. And of course, look, I don't want to get ahead of myself. We're not even down to the trend line yet. And even then, they'll probably step in and buy it there. That's probably where we'll get the first bounce in QQQ. I'm just saying longer term, if that breaks down, that's going to take a lot more out of NVIDIA, which will take a lot more out of QQQ due to both its mathematical weighting from its market cap, as well as its psychological importance, being the undisputed king of the AI bubble. And AI is still what's keeping Microsoft and Alphabet aloft. Speaking of Alphabet, post-earnings pop, and nothing but a fade so far. Nothing goes down forever. Remember, we've had, since the earnings pop, this thing's dropped, giving back almost 7%. So dip buyers are bound to step in somewhere, and they stepped in today, but the thing closed virtually flat. So still looks like that was probably the peak multi-year high, in my opinion, for Alphabet, with a lot more downside to come. But we'll see. Again, my yellow line never got violated, so this one was on a buy signal, not a buy signal, but that's my check mark there, and it has been for a long time. 149.46. So we came close pre-earnings on that pre-earnings sell-off, but not all the way there. Amazon, same thing. Kissed my key 165.74 yellow level, still above it, but still on a sell signal. Broke down from the big bearish rising wedge, went down, hit that major support that defines this gap right here, the bottom of the gap. Post earnings pop, but it's not really gone very far. They blew it off the ball, the cover off the ball. I think didn't pay attention to the earnings. All that matters to me is how the price action. And it's just it's under there. If I looked at this chart and you didn't even tell me what it was, it's what would you do with this stock if you had to go long or short? Short all day long. It's a bearish rising wedge breakdown. Hit the first very, very good support. There was minor support here, right there, 171, but then great support at 176 right there. Hit that, bounce where I would expect it to bounce, and we'll probably now go on down to my next targets here. 159, and then the purple uptrend line, the 200-day moving averages. If we start doing this and everything else does that, QQQ gets up there, well, I'll give you my thoughts if and when that happens. It's certainly possible. It's just not my most probable scenario at this time. And again, the point of this video is to reiterate, nothing has changed. We're still in these pretty good sell signals. Meta, my magic number was first this yellow primary uptrend line right there, gap down on earnings, and even took out my secondary key support, which is comparable to that gap I just showed you on Amazon. There's a big gap right here, that right there, and that's 450, 443. So this one's just consolidating because it had a big drop. And again, Pavlov's dogs will do what they do. When the bell rings, they salivate. They think they're going to get fed. Dip buyers coming off a multi-year high and all-time highs in some of these stocks, they're going to buy these dips. So, but what happens is, once the next levels get broken, that's where you start to see the more, that's where they start to kind of give up and realize that, then classical conditioning. Pavlov was, what was he? I think it's B.F. Skinner was the one that shocked the rats. That's what it was. And so you keep buying dips, and once it stops working, after enough shocks, then you alter your behavior, and they'll stop come running. And that's when we'll know. We're far from that, guys, right now. But we take out the 200-day moving averages, because I'm listening to even the perma bulls that are kind of conceding that we need to at least say the market got ahead of itself, had a big run since last October or so, and pull back to the 200 sounds reasonable. And again, that's where they're going to buy. They should buy. But ultimately, if the 200s go, whether they get sliced through initially, and I'm talking about the market, guys, by the way, but all these stocks are going to come in around the same place, all these big fangs. But SPY, the S&P 500, breakdown, little kickback rally here. It's coming down all the way down here, about 460, 678. 200-day moving averages are there. QQQ. And again, that's where the dip buyers should step in, quote unquote, will likely step in. And the big question is, this is where, if you're longer term bullish, that's where you want to position and throw away the key with stop somewhat stop somewhat below. As a swing trader, if we get there and the charts confirm at the time, I'll probably be, apt to game a bounce, cover shorts, but then reposition back for a breakdown below those levels. But I'm getting, again, 5 sets ahead of myself. We have to take out the support levels below that I've already covered in this video. So it's first things first. We get that, and then that'll increase the odds. And really, it's at this point probably the recent lows in just about all the indexes, including SPY and everything else. Okay, let's wrap it up here. The video is only about a half-hour video, so it's not too bad. I'll get this one out to you. And then, let's not forget the last of the lot right here, last of the big techs report tomorrow, Apple. And I'm debating. I'm just going to tell you. I've made some, unwavering calls so far. On stocks that reported. Caterpillar, and it was down. Meta was down. Alphabet still above where it reported. So I'm not right yet. But I said it's the trend that evolves afterwards. It's been nothing but selling, but we're still above there, so I'm not giving myself a check mark there. In fact, right now it's a minus mark. Microsoft has faded all of the, it's below where it was earnings, so there's another check mark. So batting not 1,000, but about, batting 750, 800 that. Apple, and I'm talking about calling them down from earnings. Longer term, this is a bearish chart. Apple's taken out that long-term primary trend line, looking at a lot of trend indicators being bearish. Like I said, it, along with Tesla, until recently, Tesla just hit the major resistance. But you have divergence here. But I'm going to go ahead. I'm just going to call it down post earnings. And again, that's not the day of. Here's resistance levels. If it rallies into 180, that's a big level. If you want to trade it individually, you could short it there. Or if you're long, you could sell it there. But you have the 200-day moving averages. Remember, this one's already below its 200 days. So despite these, what I call my beloved positive or bullish divergences, I think this one's going to go down. And that's finally going to be that probably the final knife in the heart of the bulls that get us down, again, are the catalysts to bring us down to the 200 days and my next targets here on the on QQQ. So we've already had the expected rally off T2, and that's why it just doesn't mesh that Apple does much more than just maybe another pop, maybe give us another back test of 433, but I'm not favoring it. I'm going to call that one down. And so that's tomorrow after the close. Either way, hey, I'm going to be right or wrong. do what you want with your positioning. All I can say is that, somebody asked the question, if you're somewhat risk averse, I know that's an oxymoron for, active swing traders, stock traders, people that do what we do. But if you are not very aggressive, let's say, nothing wrong with lightening up or hedging up. Wait till Apple's out of the way, and then you can always, go back to a full position if you are, again, shorting QQQ. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.